start. So I'll just maybe,
Yeah, go ahead, Sandeep. I just
yeah,
started the recording, so please go ahead.
yeah, sure. Thanks, Rajeev. Yeah, welcome everyone. This is our webinar series for investing, and I find it to learn from the astute investor only, Rajeev Agarwal, who is also alumnus of IIT Bombay. Um, He runs DoorDarshi India Fund, which has impeccable record in terms of the growth of the funds that he grow. We have been benefited by his advice. Rajiv, thanks for that. Just after COVID, we were able to have a session from you, learn how to do value investing in India. And taking that only in the next step, what we also see is because of the tariffs, there are themes which can get benefited, and there are themes wherein like we have some concerns emerging. So that's why I thought that we will have this topic in order to really understand which could be the beneficial themes and what could be the impact on Indian equities due to these tariffs. How long this will be going on because now there are also some uh, shake hands, or let's say some sort of arrangements happening between US and India as well. But still keeping in mind how this impact in the Indian equity environment is what all want to learn. And if you can have some themes emerging, some stocks or some specific case studies, if you want to present, I think that will be really good to all the audience to benefit from your wisdom. With this, I hand it over to you. And thanks. So, how we will do it is that Rajiv first presents about his journey and the theme. And thereafter, towards the end, we will have it open for questions and answer. People just can raise their hand. We'll unmute one by one, and accordingly, we'll take the questions. Yeah, over to you, Rajiv. Thanks for this.
Great. Thanks a lot, Sandeep, for organizing this. As you point out, we did a session almost 5 years back after COVID, and that was a very good session. Enjoyed presenting. I always like presenting because some of the messages that I will give you is also the messages that I try to tell myself. So it's a wonderful way to reinforce some of the things. So we are talking about investing in Indian equities in a post-tariff world. And what I will do is I will go through the agenda. But before that, let me just give you a few disclaimers because I always like to give disclaimers whenever we are presenting. So the first thing is that whatever I'm presenting is only for learning purposes. It should not be reproduced or used for any other purpose, and not we would want it to be disclosed in a manner which is out of context, and therefore we would encourage you to reach out and take our approval or consent before you share the information. The second thing is there might be some forward-looking statements, and since I run a fund, we want to be very clear that these forward-looking statements are only assumptions and estimates, and we would encourage the participants not to put too much of reliance on these forward-looking statements. Wherever we talk about securities, anything you should assume that we are clearly biased, and whatever we are saying is not a realistic view, but a biased view, right? And so you should not put, again, too much reliance on that view. But I also talk about my returns to Sandeep's point. And of course, these are historical returns, does not guarantee anything about the future. And lastly, this presentation is not about selling anything, right? We are giving this session, doing this session to ensure that you understand what works, what doesn't work, and what we think about it. Any selling or any solicitation will be separate, and it will be done through a proper documentation that we will share with the individuals who are interested. So with that, let's jump into the presentation. So what I have done is broken down the presentation into two halves, if you will. The first half is really talking about the background, where I'm talking about myself, about the fund. Then I talk about why we like India and Indian equities so much. So it really will talk you through some of the macros of India, and what gives us the comfort why we continue to be quite bullish in terms of the opportunities that is India and Indian equities. Then we will go into tariffs and how tariffs would either help or hurt India, and we'll talk a little bit about that. Then the second half of the presentation is more about the investment approach that we follow at DoorDarshi India Fund. And again, there we'll talk about a few different things. So we'll talk about what are the key tenets that we follow in our investment approach, how those tenets have translated into returns for the fund over its history. We'll talk a little bit about why we succeed, and then we will conclude. Sandeep did mention about any themes, so I think we will take that during the Q&A because there are some case studies I have, but they are a little bit old. Happy to go through that if there are questions around that. But I'm also mindful that we have around an hour. I think this presentation will go on for around 40 to 45 minutes, and therefore we will have limited time unless we extend the time, in which case happy to take any questions and elaborate on some of the other things that may be of interest to the participants. Okay, so let's go into the background a little bit. So a little bit about myself. So I started my investment journey more than 20 years back. Since for more than 20 years, I've been investing in Indian equities. And I became a full-time investor in 2016 after being in the corporate world for more than 2 decades. I launched DoorDarshi India Fund in 2021. And I'm also a top-ranked analyst on SumZero. Now, SumZero is a platform where analysts can post their research. There are more than 15,000 analysts on the platform. And I'm ranked number 1 across those 15,000 analysts in East and South Asia. So anybody who is posting ideas on East and South Asia, so obviously India is part of that, I am ranked number 1. I'm also ranked number 1 in financials, as well as number 1 in special situations. And across all categories, across those 15,000 analysts, I'm ranked number 2. And I'll just quickly show you a little bit. I don't know if I can. Okay, I can. So these are the rankings as of July that you can see here, hopefully. And you can see some of the ideas, some of the research that I posted on SumZero and how they have performed, which is what has enabled the ranking that I'm talking about. So this is, again, as of July 2025, which is this month. So in East and South Asia, all the ideas that I post on the platform are really Indian ideas. So you can look at some of the case studies if you want to hear. The first one is IDFC Limited, which is no more in existence because it has merged with IDFC First Bank. Second one is Ujjivan Financial Services Limited, which again does not exist because it has reverse merged into Ujjivan Small Finance Bank. And so these two are examples of special situations that we had, which is also what has enabled me to have a number 1 ranking in special situations, not shown here. The third idea is IIFL Finance. And the most recent idea or most recent research that I had posted was on Repco Finance. And so that is the most recent one. But I've been posting on SumZero since 2017. So there are quite a few ideas that are on the platform. Before starting my investment journey, or before I start becoming a full-time investor, I was in the corporate world, and I retired from S&P Global as a managing director. And prior to that, I worked with firms like Goldman Sachs, Bank of America, and JP Morgan in various capacities. In terms of the education background, I'm a CFA charter holder. As Sandeep mentioned, I'm a BTech from IIT Bombay and an MBA from IIM Calcutta. A little bit about the fund. So the fund is DoorDarshi India Fund, is a US domiciled hedge fund, which is registered as a foreign portfolio investor into India. And therefore, we are benefiting from the growth which is happening in India. And the focus of the fund is to invest in public equities which are listed on the Indian exchanges, which is the National Stock Exchange and Bombay Stock Exchange. And we have the full set of securities available to us. But we also occasionally can invest in US exchanges into companies which will benefit primarily from India's growth. So the focus is India's growth. And because occasionally we might find companies on US exchanges might be more compelling and they might not be available on NSE, BSE, but they have to be focused on India. So Google and Meta and all that will not fit our mandate. The fund started, as I said, in April of 2021. And since our inception till date, we have a history of outperforming both Indian and US indices, and we'll talk more about it. The fund actually has a long-term orientation. And so one of the ways of reflecting that is how often your portfolio turns over. And so since inception till 2024, the fund's turnover is 18%, which effectively means that we hold a position for around 5.5 years on average. Now, what this fund enables is the international investors who do not have access to India to participate in India's growth story, as well as benefit from the diversification. So what is very interesting is that the correlation between our monthly returns and that of S&P 500, which is by default the index for most international investors, let's call it, is less than 20%. And what that means is that you can have very good diversification benefit when you invest in the fund, and most of your portfolio is into S&P 500 type companies. Okay, so with that background on the fund and the fund manager, let's talk about what we like about India and Indian equities. And for each of the slides that I'm presenting, at the bottom, you will see the source. So these are not something that I've come up on my own, but I've taken it from some reports. So I'm not going to keep mentioning the source of these charts that I'm presenting, but you can look at it at the bottom. So if you look at the India's GDP growth, both in the past and in the future, from calendar year 13 to 23, India grew at 5.7% real GDP growth. And that was the second fastest after China. If we look from 23 to 28, India is projected to have a real GDP growth of 6.3%, which will be the fastest growing large economy, with the next one being Indonesia. China actually falls down to 3.9%. So one reason we like India is because India will have a very high GDP growth. And with that GDP growth, India is expected to be around $6.6 trillion of economy by the calendar year 2030, comfortably overtaking both Germany and Japan in the process and becoming the third largest economy. Now, Motilal Oswal has this report where they say that from 4.1 trillion, which is at the end of financial year 2025, India is expected to become a $30 trillion economy by 2047. And that would imply around a 9.5% CAGR in dollar terms. Now, 9.5% CAGR seems high, but the way to think of it is that if India's economy on real terms can grow between 6.5% to 7%, and dollar inflation is 2.5% to 3%, then that 9.5% CAGR is achievable. And if that happens, India's economy will be a $30 trillion economy by 2047. So that's one aspect with it, which is a GDP growth, both in the past, but in the future, things are looking really bright. What will drive this GDP growth is the demographics. So if you look between now and 2045, India will add almost 179 million people in the working age. And working age here is defined as people who are in the ages of 25 to 64. What is also unique about India is almost no other country will have that sort of growth in the working age. The next best one here is US. And you see on the right-hand side that China will actually have a degrowth of almost 103 million. And as we know, that GDP growth is a combination of capital, labor, and productivity, right? And labor is one of the big elements. And you can see that India will have a significant growth in the working age population between now and 2045, which will drive the growth that we talked about. The other thing that I hear a lot people talk about is that in India, the economy is growing without the capital expenditure. That is actually not the case. And it's good to actually break some myths as I'm presenting, because if I'm just telling you what you already know, it's not quite as beneficial. So you will see here the capital expenditure that is happening in India across state capex, which is the dark gray. Then you have the central capex, which is the medium gray, and then you have the listed corporate capex, which is a light gray. What has been talked about a lot in the media is that the corporate is not doing capex, and that is not true at all. You can see in financial year 25, there was 11 trillion rupees of capex, which actually was higher than the central capex of around 10.5 trillion rupees. And so last year, as in financial year 25, the corporate capex started exceeding the central government capex, which was higher than the state government capex. And that is what is projected to continue. So not only is the demographics good, but also the capital that is required to grow the economy is continuously coming into productive uses. And we'll see how productive this capital is. The other very interesting thing about India is that the leverage is not that high. So if you look at the debt to GDP of India versus other countries, you will notice that India's debt to GDP has not really grown as fast as some of the other major economies out there. So India at around, let's call it around 170, 180% of debt to GDP. And I think the only other country which comes around this number is Brazil. Almost all other countries, be it China, UK, Japan, Korea, USA, Thailand, whatever, all of them have debt to GDP, which is much higher than India. And remember, we talked about GDP in India will grow at a much faster rate than all other economies, large economies. And therefore, the debt to GDP number will actually become even better as we look further out, because the denominator is growing at a faster rate for India. And that is another huge macro driver, which will make the macros better and will over time reduce the cost of capital in India and therefore give better returns for the investors. Fourth driver, formalization. Now, again, this is not something that necessarily is talked about enough, but the number of tax filers in India, if you look at it from 2012 onwards, which was around 31 million, has almost become 2.5 times at 80 million at the end of financial year 23. We also know that recently there was a budget where the tax below 12 lakhs will not necessarily, the tax filers don't have to file. So it is possible that the number of tax filers will not grow as fast in the next few years because the tax exemption limit has gone up. But even then, the fact that more tax filers are coming into the net tells you that the economy is getting formalized. And what was not getting reflected in the GDP numbers in the past will more and more get reflected in the numbers. GST is another big driver of that formalization because it's very hard for businesses not to be under the net. They have to now report because of the incoming GST benefits that they get as well. Now, we talked about the capex. Now, this is a chart which shows you how the return on capital or return on equity, more specifically, of listed companies in India has done over the last 25 years. And what you will notice is that the return on equity, which is an indicator of how efficiently you are utilizing your capital, is, let's call it, between 12 to 15% on average, right? It fell below 10% and in COVID year, and since then again has started the climb, and it is now around 15-16%. When we look at this return on capital, what you will realize is that it is among the best, not the best, because US listed companies have a better return on equity, but it is the second best in the whole world, according to this chart. And so India's return on equity at 16% tells you that the Indian entrepreneurs and the Indian businesses are utilizing that capital in a very, very efficient manner. The benefit of utilizing the capital in an efficient manner is that you can grow your company without taking a lot of external capital. And that is what we are seeing with Indian companies. I talked about how the Indian economy will become a 30 trillion by 2047. Here's another chart from Motilal Oswal, which says that while India's households have saved, or India's gross savings has been $14 trillion so far, it will add another savings potential of 126 trillion between financial year 26 and financial year 2049. So you can imagine almost a magnitude change in the savings potential of India's households in the next 25 years. So not only are the factors, the macro factors, very good, but because of those macro factors, India's economy will grow. And as it grows, there will be a lot of savings that will be done. And you can see the magnitude of the savings that we are talking about here, which is almost 126 trillion. You can apply some haircut if you want, but still the numbers that we are talking about as we look into the future is really, really big. Now, where is all this savings going? So if you look at where households have invested their savings, and this is as of financial year 2024, you will notice that almost 50% of India's household savings or household assets have gone into property. Next is really more of the gold and the bank deposits. So between property, gold, and bank deposits, Indian households have 75% allocation. And the allocation that is there to equities is only 6.9%, right? So that is what the allocation is. And there are some other allocations which we can ignore for now. What is interesting to see is how this allocation of India's household assets have changed to equities. It used to be around 2.2% in financial year 2013. And in financial year 24, it has become 6.9%, which is almost a 3x, more than a 3x in the last decade. So increasingly, Indian households are allocating more to the more productive assets and assets that do far better in terms of the returns, and which is equities. And then I talked about almost $126 trillion worth of savings in the next 25 years. Guess what? A lot of that will come into equities. And if this drive towards having more and more of your assets into equities continues, then a lot of inflow will continue to come into equities. Here is an example of how the equity flow has been from domestic institutional investors. And on an average, you will see somewhere around $5 billion plus that has been coming on a monthly basis into equities in the last 1.5 years. So what I'm talking about and what we are seeing here is still just the tip of the iceberg, because as the savings increase, you will see more and more of that savings come into equities, and therefore a lot more will come into those equities either through DIIs, which are domestic institutional investors, or through individuals. Why we think that equities allocation will continue is because you can see that currently the household allocation to equities in India is really low as compared to the household allocation in other countries. US is almost 40%. And then many of the other countries are in the 20 to 30%. And India is right now at 6.9%. So there is a long runway for the equities allocation to continue to increase. And I think that will be another big driver for the Indian equities. And lastly, it's good that we are talking about what will happen in the future, but we should also look at what has happened in the past. So if we look at, and these are the historical returns of MSCI indices across major economies. And what you are seeing here is the returns in dollar terms. So these are not in local currency. This is in dollar terms across 5 years, 10 years, 15 years, and 20 years by various indices. And what you will notice is that BSE 500, which is a pretty broad brush measure of how the listed companies in India have done, have been in double-digit range almost across all periods, right? Now, I should point out that this chart was put out around September 2024, which was a peak of Indian equity market, and then it came down some. But over the long term, the 13.6 can become 12.6 if you are having a 20% drawdown, but it doesn't change dramatically the return that you are seeing across different time periods. And so I think my submission here is that Indian equities have done really well. And this is what is not understood by many people. They think, oh, INR has depreciated so much, so in dollar terms, I don't get enough returns. And then you look at a chart like this, which shows you that in dollar terms, even in dollar terms, Indian equities have done better or similar, depending on what time period you take, than most other indices. If you look at the other few indices other than S&P 500, which has done quite well, and in similar range to that of BSE 500, Indonesia has not really done well in the last 15 years. So it was booming economy a while back, and since then has slowed down. And then Taiwan is much more dominant in semiconductor space. So really, Taiwan is not a pretty diversified set of companies. It's much more into semiconductors and electronics, so very much more focused. But Taiwan has done well, and India has done well, and US has done well. And those are the three countries where the stocks have done very well over the 5, 10, 15, and 20-year period. So, okay, so that's the other thing, which is that Indian equities have done well. So if I just summarize what I talked about in terms of why Indian equities and why we are so excited about Indian equities, we think that by investing in Indian equities, you're participating in the fastest growing large economy. And that large economy has good macros where the debt to equity or debt to GDP is coming down. And it is getting increasingly formalized, which means that more of the growth will reflect in the GDP numbers. There is a lot of tailwind that is available to the companies because of the growth. And the good news is that companies, unlike in China, where the return on capital is very low, in India, companies do take good care of the capital that is presented to them. And this is represented by the good ROE, the return on equity, as we saw vis-a-vis the world. In addition, because of the growth, the savings will grow up significantly, and more of that savings are coming into Indian equities, as we have seen, which will be a big driver for improvement in the equities market. And then lastly, all of that should allow Indian equities to do well over the long term. And as I showed you in that table, Indian equities have done well in the last 20 years. But if I look in the next 20 years, I feel that the setup is very well placed for Indian equities to continue to outperform over the long term. So what is the problem with this picture? There's always a but, by the way, right? So the problem is that Indian equities are expensive. They're not cheap. Okay, so if you look at Nifty 50, it is trading at around 21 times. Average is around 18 times. Similarly for Nifty Mid Cap, which is trading at 29 times. And it's Nifty Small Cap, which is trading at 26 times. So all of these indices are reflecting the fact that Indian equities feels like, or Indian economy and Indian equities feels like it has a good future. And so the valuations have already gone up. And this is always a challenge that we have in the markets, which is that, yes, the prospects are good, but is the valuation compelling enough given the prospects? And that is the challenge, that valuations are stretched in many cases. So that's the Indian equity story. Let's talk a little bit about tariffs, which is one of the conversations that we wanted to have here. And so let's look at tariffs from a US perspective, because clearly what we are talking about is the US-India trade. And if you look at, and by the way, this chart was created by me using ChatGPT, so pretty impressed with ChatGPT. So you can see here that US exports to India is around $40 billion. And the US imports from India is around, let's call it $90 billion, right, approximately. And so the trade deficit has been around $45 billion in 2024 calendar year. And you can see that the trade deficit was flat, and then in the last few years have continued to increase. So that is a context in which we should look at the tariffs. So if you look at the India's merchandise export to the US, which is around 90 billion, that is around 2.1% of India's GDP, and that is 17.7% of the total goods exports from India. So overall, India's economy is around 4.2 trillion, exports are around 820 billion, imports are 920 billion. And so India's exports to US of 90 billion is around 2%, not a very significant amount, and surplus is around 45 billion. So it is quite easy to actually reduce that surplus by importing more of energy, and US does produce a lot of energy, especially gas, which is in a significant quantity, which the US does not really know how to utilize, frankly. And India has a growing gas economy, so CNG and so on. So I think there is a lot of import potential, both in energy, where India almost imports more than 85% of the oil and gas need it has, right? So there is a significant amount of import that can come from the US. And then the second one is India still imports some of these big defense equipments, which can also start coming from the US. And both of those can reduce the surplus meaningfully if India were to do that, and if India and US agree on that. So first is the India's exposed to exports to the US is not that big, and second is the surplus is not that big that if you start importing a few things that can be addressed. And I think both of that should frankly not have a big issue from a tariff perspective. The second thing is India's economy is going to grow at 6 to 7%, even if there is some tariffs on the 2% that we export, that India exports to the US. It will not have a meaningful difference in terms of how India's economy growth rate will be. So those are the two main things around the tariff. And what many times you forget is that tariffs actually has an upside. And the upside is that India's economy is primarily domestic driven. And so if there is tariffs, maybe more of those exports will get rerouted towards the domestic industry. As I showed, of the 4.2 trillion economy, 820 billion is exports, 920 billion is imports. So really most of the economy is going towards domestic purposes. India and US, as we all know, is working through a bilateral trade agreement. And I think as of now, the date is extended till 1st of August. And it is very likely, given how the letters have gone out from US to various partners, but not to India, that tells me that India and US are making good progress. And even if it is not a comprehensive deal, I think initial contours of the deal will be in place. Because both India and US, I think it is in their best interest to work together, given that the world is trying to move away from a Chinese supply chain. Apart from that, India is actually doing a lot of free trade agreements, right? So there was a free trade agreement that was done with UK. There's a free trade agreement that is going on. Discussions are going on with EU, UAE. There was a free trade agreement. Middle East, many other countries, there are going to be free trade agreements over time. And so what that tells us is that there will be bigger markets for the Indian companies to export. And that will be an opportunity for Indian economy and Indian companies to do well. The other important point, which is again not talked about enough, is, as I said, India's crude imports is more than 85% of its need. And if the crude prices go down, then what it does is it reduces your import of crude in terms of the dollar amount, right? Not the quantity, but in terms of the dollars that are going out, as well as it reduces the fiscal deficit and inflation in the Indian economy. Many of you would have noticed that the inflation in India has come down quite meaningfully in the last few quarters, which has allowed RBI to reduce the rates. And one of the reasons for that is food, but the other reason is that the energy prices are also coming down. And lastly, we know that rupee keeps depreciating over time, but in the last few quarters, the rupee has not only not depreciated, but has appreciated somewhat, which allows one to invest more into India because you don't have the headwind of depreciation, and that may allow more FPI and FII investments into India. So that's sort of the tariff thing. Now, let me switch gears rather than giving you background, talk a little bit about the fund, what we do, how we invest. So first are some investment tenets in terms of how we invest when we are investing, what are we looking at? So first is the expected return framework. And so whenever we are investing in any company, what we want to do is to look at what is our expected return, given the current price, what we think the price will be over the next few years, and come up with the potential return opportunity that we have in any company. And this is the base of what we try to do. Sandeep earlier referred to doing value investing, but another way of representing value investing is through this expected return framework, which is knowing what sort of a return potential we have. Whenever we are investing, we are always focused to ensure that we are investing with good management, because we fundamentally believe that we cannot do a good deal with a bad management. So we want to always associate with management we can trust and be comfortable with. Whenever we are investing, we try to invest in our circle of competence. So many times what will happen is, while we don't understand the company, we will try to keep learning about the company and the business. The more we learn about that, the more comfortable we can be. And the more comfortable we are, the more we can invest in that particular company. So having that circle of competence and then investing in that gives us an ability to be able to withstand any challenges. We have a long-term orientation, so we are looking multiple years when we are investing, and that allows us to be different than what the rest of the market will do, because market's always focusing on the next day, next week, next month. maybe next year, but not beyond that. And when we are looking, we are primarily looking a few years out. And that allows us to think differently than the market. And that is one of the important tenets of how we invest. And not only it is important to do certain things, but it's also important not to do certain things. And so, for example, everybody talks about how volatility is risk in the investment world. We don't think so. We think volatility is a source of opportunity, because if something has gone down and we like it, we are happy to buy more of it because it gives us better return expectations based on the above formula. On the other hand, if something has gone up a lot, we can sell that and deploy our money elsewhere. So volatility for long-term investors is not only not risk, it's actually a source of opportunity, and we differ from the street on that. We also don't like to diversify for the sake of diversifying. If we have a return opportunity which is similar across 3 companies, we are happy to diversify. But if one company is having a much better return opportunity, we would like to concentrate. And as Buffett has said, if you know something, it makes much more sense to concentrate. But if you don't know something, it makes sense to buy a broad-based index like a S&P 500, which is a diversified index. The third thing is we don't focus on how our portfolio compares to the benchmark on a regular basis. What we want to do is find good companies and invest in them. In fact, if I look at my portfolio today, the fund portfolio, it has almost nothing in common with the Nifty 50. So we don't own any of the top 50 companies in our fund, because we don't, even though, and I will show you the historical results, even though we compare ourselves to Nifty 50 and MSCI India and S&P 500, the reason we compare to those is because that is the opportunity cost of investing with us. And lastly, we are not focused on just increasing our AUM. Our goal is to deliver good returns over time. And AUM is a byproduct. As and when it happens, great. If it doesn't happen, that's great as well, because that is not a metric that is important to us. What is important to us is following these investment tenets and over time doing well with that. In terms of the portfolio allocation, as we all know, in investment world, the returns are distributed based on the power law distribution. And what that means is only a few stocks will give you the most returns, and most of the stocks will not give you much return. In fact, yesterday I was reading this article which said that from 1928 to 2020, there were only 2% of the companies that gave you 90% of the returns. So you can see how skewed the distribution is. And because the distribution is so skewed, you want to concentrate into your best opportunities. And that is what we do with our portfolio. And so we want to have a concentrated portfolio where our best ideas get the most allocation. And as our confidence or as our expected return goes down, the allocation also goes down. The reason to have a long tail is to ensure that if over time either our comfort with our business increases or the return expectations improve, then we can have more allocation to that particular company. The other thing that we look at is whenever we are investing in a company, we want to know what is the alternative. What else could we have invested in that we are not able to invest in because of what we are investing in? And that is the opportunity cost. And this is really what Charlie Munger always talks about, which is whenever you are investing, you have to figure out what is the next best alternative you have and then decide if you should invest in that company. And hopefully, using this portfolio allocation along with the portfolio selection or company selection that I mentioned will help us deliver strong returns. Risk management, very important consideration whenever we invest. The most important considerations are listed here. First, do we understand the business? If we do not understand the business, we cannot value it. If we cannot value it, we cannot invest because we don't know what should be our return expectations. We want to look at the past track record of the company and the management, because the past track record tells us something about how the company and the management have behaved in the past. And many times our behaviors or what we do in the past is likely to repeat in the future because we are all creatures of habit. The other one that we want to look at is management incentive. We want to ensure that management has incentive to do well. And that is actually a lot easier in India because most of the management of the companies are also owners of that. So if the company does well, the share price does well, management becomes richer because they own most of the company, and we as shareholders do well, which is a good thing. We also want to have capital structure which will allow the company to withstand any adversity. And so the less there is debt, the less there is the preferred board stock type of thing where you have to pay a fixed interest, the better off the company is, because then you can take advantage of any surprises that show up from time to time. One of the very important factors in terms of managing risk is compelling valuation, because compelling valuation allows us not only to get better returns, but also lower risk. And so this is a very important way to reduce risk. And lastly, the position sizing that we talked about, of how we position size, and that is also an important element. So the less confidence we have, the lesser the allocation, higher the confidence, higher the allocation. So all this then allows us to build a portfolio, which then allows us to do well. Okay, so with that approach, let's talk about returns, how we have done. So these are the table. Let me just walk you through some of the important elements. So since our inception, so the fund started in 2021, April, we have had a 25.8% dollar returns on an annual basis. This is compared to S&P 500, which has delivered a 12.7% in that same period. Nifty 50 has delivered a 10.2% in that same period, which is April 21 to December 2024. And MSCI India has delivered a 11.1% return. So clearly, we have significantly outperformed all the various indices that are there that many investors would invest in. If we then look at how this CAGR has transferred into total returns, so if you had invested $100 in the fund in April of 2021, it would become $237, right? So everything that I'm talking about here are in dollar terms because our investors in the fund invest in dollars, right? So we have had a total return of 137% versus a 57% for S&P 500, 44% for Nifty 50, and a 49%. So you can see the significant outperformance. Now let's talk a little bit about what is causing that outperformance. And so the third one here shows the comparison of fund and S&P 500. And so what you will notice is that S&P 500 in 3 out of those 4 years has given a 20% plus return. And the fund, on the other hand, has given you a single-digit return in 3 of those 4 years. But it is in that 1 year that the fund had a massive return, and actually S&P did a negative 18%, and the fund did 81%, right? And therefore, the CAGR and the total returns look very different. And then the next logical question is, oh, well, what did you do differently in 2023? The answer is we did not do anything differently because the returns in the stock market are never linear. They come in chunks, in an episodic manner. And what all you can do is find good companies, find good stocks at good valuation, and be patient. And that is what we have. And that is what is reflected in our returns since the inception of the fund till 2024. So let me give you a few important caveats around this whole thing. First is past performance does not guarantee future results. Very important disclaimers. Do not project this out into the future. Everything that I'm presenting you here are returns that have been audited by our auditor, which is Spicer Jeffries. And we are not talking about 2025 returns because they're not audited. The year is not over, right? The returns reflect returns, the fund returns reflect returns of all the limited partners in the fund in dollar terms, which is after fees and after expenses and after Indian taxes. I mean, I think this is an annoyance for me, but that is what the reality is, that we actually have to deduct Indian taxes when we are looking at fund returns, which is not the economic reality, because all our investors in the fund are investing from the taxable account and they get benefit for the taxes paid in India. Now, when we look at S&P 500, Nifty 50, and MSCI India, these are returns again in dollar terms, but they reflect the total returns, including the dividends. So just showing the same return slightly differently, $100, as I said, have become $237 in the fund versus between $140 to $160 in the 3 indices that we compare ourselves to. Why do we compare ourselves to these 3 indices? Because those are the 3 indices that our investors are likely to invest in if they're not invested in the fund. As I said, these returns are returns after taxes in India. But because most of our investors invest from their taxable account, the right way to look at it is fund returns before taxes. And the fund return before taxes is an even better story, where the 25.8% CAGR becomes 27.9% CAGR. And the 137% total return becomes 152% total return, which we think are the real economic returns. So it is fair to say that the fund has done very well, and it is much higher than what I would have expected going into when I started the fund. And we are very, very pleased with how the fund has done since inception. So let's talk about, and when I present this, the question that I'm asked always is, why do you succeed? What is it that allows you to provide these type of returns when we know that most fund managers, almost 80% of the fund managers, are not even able to beat S&P 500, forget exceed, right, by such a big margin. So what are you doing differently, which is allowing you to succeed in this manner? So a few things. One, that I talked about our investment philosophy, investment tenets. That is critical. You need to know who you are. And in a stock market, in a equities market, if you don't know who you are, stock market is a very, very expensive place to find out. So you need to have your philosophy well defined, and you know why you are having that philosophy. Once you have the philosophy, then you need to have the process around. And the process is, how do you go about selecting stocks, testing those stocks, how do you allocate that stock to your portfolio? All that is very important. And this is where discipline is very important, because every day you can buy so many companies and every day you can sell your holdings. It's so easy to buy and sell. But knowing when to buy, why to buy is critical. And therefore, having the discipline and the patience is critical in success. And all of that then leads to your portfolio creation, which is sort of the core of what allows you to succeed or not. In addition, we ignore some of the things that do not matter. I talked about it earlier, but too many people in this industry focus on looking good, right? You want to have the best office in the most expensive location because you want to show how good you are, but that doesn't tell you anything how good you are. Neither does AUM, neither does whether you have a low volatility. I think one of the standard metrics in this industry is the Sharpe ratio. And we think Sharpe ratio is flawed because the denominator of a Sharpe ratio is volatility or standard deviation, which we don't agree with. Similarly, diversification, for the sake of it, is not meaningful. But if you get good returns, then yes, diversification makes sense. And lastly, we try to avoid fads. We don't want to invest into things that are popular because by definition, they are not necessarily cheap. I just was looking at the time. I think I have to speed up. So a few more things. Why do we succeed? We want to only have right investors. So we are very selective when we take an investor. We don't want to take any and every investor in the fund because many of them do not have the right orientation. We accept only long-term investors because that is what the fund is. And I will tell you, since our inception in 2021, we had only one investor who has withdrawn money. And even that investor has invested through two vehicles. So he pulled money from one of the vehicles, but is still invested through another investment vehicle. So we haven't lost even one investor since we started in 2021, which is a rarity in this investment industry. So we are very particular of whom we choose. We want to ensure that they understand our philosophy, they can think long-term, and they realize that volatility is an opportunity and not a risk. We want to invest at the right price, which is ensure that we can have high return expectations and low downside. And the right track record gives us a confidence, but we can also be very selective when we are investing in any company. Okay, so let me conclude a little bit about India and Indian equities that we covered. Indian equities have been, in the last 10, 20 years, have done very well and are likely to be among the best performing asset class in the world over the long term. Why is that? Because India has a strong macro and the evolving geopolitics is making the case even stronger. In the short term, Indian indices are fully valued. You saw that. In fact, possibly overvalued. However, there are always pockets of value, and you need to find those pockets of value which you understand, because we should always remember that a good business at a bad price is not a good stock, and too many people forget that. And then tariffs, which is what we wanted to talk about here. We believe that tariffs may have a short-term sentimental impact, but are unlikely to have a long-term economic impact on India. In fact, we think there's upside to tariffs. And because if India is better positioned than some of the other economies, then maybe more business will come to India. And tariffs may also provide a good entry point if markets react negatively, because as I said, that will be a risky event for the investors, but it will possibly provide us good entry point. In terms of the fund, so DoorDarshi India Fund allows international investors to benefit from the growth of India. Fund has delivered 26% CAGR approximately versus 13% by S&P 500 and 11% by MSCI India. So you've done very well. And US investors also benefit from the diversification, where there's only a 18% correlation between the monthly returns of the fund and the S&P 500 monthly returns. So really a good diversifier as well. One of the suggestions I will make to anybody who is listening to the call is in investing, always look for alignment of interest. And the fund has a very high alignment. As a fund manager, I am the biggest individual investor in the fund. And therefore, if the fund does well, I do well. And that is perfect alignment. And lastly, the fund aspires to deliver strong returns. That is our purpose of existence. And while we cannot promise any returns, we think there is a probability that we can deliver over time a 2x over 5 years, which would be a 15% CAGR. There are no guarantees, and so we are not guaranteeing anything. We cannot guarantee anything. But there is a decent probability of that because our past record gives us the confidence. And if we were to do that, then that would be 50% better than a S&P 500, which has a historical return of 10%. So that's sort of what the fund is. I will stop here and take any questions now.
Yeah, so Rajiv, there are first of all, not a question, I guess, but this is about what is being said is that taxpayer below 12 lakhs may still go and file the return because of claiming of TDS and TCS. I think that's something that is a correction. And there is a question in a chat from Shivam, and he want to understand that can someone living from India invest in your fund, and what will be the minimum criteria to invest in?
Okay, so we don't right now have a vehicle in India for people to invest with us. So this is only, the fund right now is only for international investors. I think we are looking at having a vehicle in India, and maybe in 2026 we may have some vehicle. But right now, our resident Indian investors cannot invest in the fund.
Yes. So the next question, which is from Pranav Madhikar, what's the correlation in your fund to Indian indices such as Nifty 50?
Yeah, I think I will have to look at that, but I believe it is around 50%. Around 50%, not exact.
50%, okay. Yeah, Rajiv, I also have a question. Maybe if you can talk about one or two case studies, which has got benefited the fund as well. I think that will be awesome for everyone to get benefited.
Sure. Yeah, so I was just, while you were talking, I was just quickly looking at what is the correlation with Nifty 50. It's 51.5%. Okay.
Okay.
That's good.
Super.
The case studies, good that I had some case studies. These are slightly older case studies, okay? And so I will quickly go through that. One is a case study on Manappuram Finance. And this case study was done by me in May of 2021. Again, any case study that I typically do, I don't want to take unless I have presented it somewhere, because that way I am debiasing myself. And I will quickly go through it because I know we are running a little over time. So I want to take as many questions as possible. But this case study, really, Manappuram is a non-banking financial company. When I was looking at it in May of 2021, there were multiple lines of business and gold, housing, MFI, vehicles, so on. It had decent capital adequacy, no dilution. Management had created tremendous value. And so, overall, it was catering to unbanked customers. We thought, okay, there is a good long runway here, and business was available at good valuation. So all that is good. How did it play out? Well, you can see not really great, right? So we did like 64% return in 4.2 years. Effectively not great because that is, well, okay. So we did like a 12.8% CAGR. And as you can imagine, that is way below what we have delivered otherwise. So while in the context of the index, maybe it delivered index returns, and actually, the 12.8% is the price CAGR. It also has dividends on top of it. So if I include the dividends, it's around 15%, but it is sort of an average performance. And so what went wrong? Company lost gold loan market share to competitors. Happened due to strict auctioning policy, and MFI did not do well, right? So that's sort of what happened. And MFI, we all know, I think vehicle, home, MSME also have not delivered so far. What is the current state with this particular company? First of all, we own this company, not a recommendation. We have owned it for a while. But right now, what is happening is that there is private equity that is coming into the company, and that will allow, and they're buying a stake in the company at 236. You saw the price at which it is right now, which is around 260 odd. So effectively, there is some change in the management. And I believe that that management can make the business a little bit more efficient over time, but it remains to be seen. Again, as I said, this is not a recommendation, but a case study. And the second one is Ujjivan Financial. You saw Ujjivan Financial has done well for us in the ranking, Sum Zero ranking. This was a case study that we presented in December of 2021. At that point, this was going through a reverse merger. And Ujjivan Financial Services Limited, you would get 11.5 shares of the bank. And effectively, at the price at which we presented, you were buying the bank share at 11.5 rupees a share when the bank share was trading at 19 rupees. So this is a special situation where you had significant upside just from the merger going through. And in addition, the banking business was in a good situation, strong capital adequacy, good economics. Management had good pedigree, strong track record, and catering to the bottom of the pyramid. As you can see, we like the bottom of the pyramid theme in India. And it was available at a good valuation. So you can see the normalized price to earnings was 3 to 5 times, and price to book was around 1.3 times. So really cheap. How did it play out? You can see here, Ujjivan Financial did very well for us, which is from December 21 to 23. And then I have taken Ujjivan Bank because it got reverse merged in 2024. So we don't have the history for all of 24. But really, the bank has not done as well from December 23 to July, which is on the Friday, minus 16.5%. But overall, we have got 255% total return in 3.5 years. And that, if you look at it from a total, just the price CAGR is 43.6%, which is really good. And so what worked is cheap valuations. We got into this particular company at a really compelling valuation. And as I've emphasized multiple times in my presentation, I feel buying at a good valuation is the only support and the only comfort one can have. And we did that. It had enough capital, did not have to raise too much. Management is reasonably good. And we continue to believe it has a long runway. Once again, we own this company, but we are not recommending it. Price is very different than when we invested and all that. So do your own diligence. But those are the two case studies that I wanted to give you a flavor of. One, average performer, one that has done well for us.
Yes, another question that has popped up in chat is, can someone in Middle East invest in your fund, and what would be the ticket size?
Yes, so people who are outside of India can invest in the fund. So somebody from Middle East can invest in the ticket size, can invest in the fund. They can reach out to me, and I can provide more details. Here are my email contact details, so they can reach out to me about this.
Yeah, and what's the total fund AUM as of now for you?
So I did say, Sandeep, and I think the question that people are asking, I don't talk about AUM because we think that is not the right metric. But we are doing well. Clearly, with the type of performance that we have put up, AUM just continues to grow. But we don't talk too much about it because we don't want people to use that as a metric for making decisions. I think what I would encourage people to do is to think through whether the philosophy makes sense, whether they have the long-term orientation, and whether they think Indian equities and Indian economy will do well. And all that is true, they have the profile of just staying put. As I said, we haven't lost any investor. We are very particular of whom we let in. So all those are much more important factors than our AUM, but AUM has grown a lot. We have done very well, but we don't worry about talking about AUM.
Okay. So Deepsha is asking, people say that value investing works in the mature markets like US and may not be so much in fast growing markets like India because of the traditional valuation model doesn't work at all. So how to go about this?
So, as I think rather than saying what works or not, I have given you the numbers. If you look at the numbers, you know that the value investing works for us. I think value investing, first of all, I think there is a huge mistake people make when they say value investing is low price to book or low price to equities. That is not correct. You have to look at growth. Growth is a very, very important part of how you value a company. And I think this delineation that is made in the literature or in the investing world about, oh, I'm a value investor, I'm a growth investor, does not make sense, because growth is a very important part of how you value a company. India is a growth market, as the questioner rightly pointed out. But if you buy that growth at a very reasonable valuations, you can get very good returns. And that is what we are trying to do. And I would say this approach, where you buy a company at a significant discount to what you think it is worth, will work in any market. In some markets, the opportunity set will be less. In some markets, it is more. The beautiful thing about the Indian markets is that in Indian markets, we have almost 5,000 stocks, of which 2,000, let's say, are investable. And so there is a wide variety of stocks that you can look at. And of those 2,000, you need to buy only a few stocks in a year, right? And so you have a lot of choice. You just need to find a compelling stock which will give you good returns and invest. And the more comfortable you are, that is where you put more allocation. So I think the two things that are required to be successful: buy companies that are very compelling, and then buy more of it when you feel you understand it well. So understand the business and then buy more of it if it is the most compelling opportunity.
Yeah. What is your advice to a new investor who got around 23% of loss in their portfolio in the recent times?
Yeah. So the first thing is, you have to figure out you have had the losses because the market is testing you, or because you did not do your work. And I think those are two very different things, right? If you understand the business, and that is what I always tell new investors. Many times people invest because somebody tells them to invest in company X or company Y, and then they will invest in that. And I think that is a wrong way to invest, because you don't know why you're investing. You don't know what to do when the stock price goes down, right? Here, the questioner says, listen, the stock price has gone down. If you knew the business and if you felt comfortable that the business will do well, this is your opportunity to buy more if you are comfortable that it will do well over the long term. But if you're not, and now you might be wondering, well, am I right or am I wrong? And that is really the big risk with investing, that if you don't understand what you're doing, you will almost always be on the wrong side of the volatility. You want to take advantage of the volatility rather than be hurt by it. And that is why understanding business, understanding management, and understanding how you value it is very important.
Yeah, that led to me a question, which is, what is your opinion on AI-based investment suggestions?
So I think AI, in my mind, is a very good tool. I think it is going to enable us to do our research far faster, much more comprehensively. But AI is no substitution right now, at least, for making investment decisions. Just like, when internet came, internet made the world's information available on your fingertips, so you can easily access all the information, but you still have to make the decision, right? I think AI will be something similar. I have asked AI through ChatGPT primarily of saying, listen, what stocks are the best? And I would encourage people to do that and see what it tells you. It will give you very vague answers. And so what it is telling me is that effectively AI is not in a position to give you answers like what are the best stocks, simply because I think investors differ, their understanding of the companies differ, and frankly, what is the best stock for you may not be a best stock for me, because my understanding of the business is very different. And I don't think AI will dramatically change that. And so till you get comfortable with the business, it is you who are making the decision. And I don't know over the next 5-10 years how AI will evolve. remains to be seen. But I feel comfortable that till human decisions are required for many other stuff, you will need the same human decisions for making investments.
Yeah, so Rajiv, there are a few more questions on Chinese equity, European investors, and so on. If you want to take that, or if you want to allow anyone who want to ask a few more questions, I think we should be taking that.
Yeah, I
So
mean,
if
very
anyone
broad.
want to directly ask the question, just raise a hand and maybe we can unmute and then you can ask the question.
Sandeep, will you be able to? You are the co-host, right? You will be able to unmute them.
Yeah, it will be. Yes, surely. So if I see a raised hand, then yeah, I can. Yeah, so there is a question on what are your views on about the Chinese equity? Can past higher returns in India reduces the potential future returns?
Right. So I think Chinese equities, a few things which are very interesting. One, Chinese equities have a low return on capital. I don't remember what it is, but it is much, much lower than in India. And so therefore they by definition should be valued lower than India. Right. The second thing is you look at what Chinese stock market has delivered over 5, 10, 15, 20 years, and that was part of the table that I showed you. And again, the track record is nothing great. The economy has grown a lot, but the stocks have not done well. And so I think past is a good precursor to what the future will be. It is not a full predictor, but it is a good reflection of what is likely to happen. And so to that extent, I would encourage people to be careful. The second reason why one has to be careful is because a lot of the businesses, you don't know what will happen to them tomorrow, right? If the ruling party decides that they are not on the right side of the party, then the business can change dramatically. And one has to always account for that particular risk as far as Chinese stocks are concerned. Coming to Indian stocks and the fact that Indian stocks have done well, does that mean that the future returns are lower? That will happen, assuming that the future growth is already in the current price. And that is why investing is almost never at the top level of saying, let me buy India, right? What you want to do is you want to buy into an environment which is conducive. And then you have to do the bottom up work of saying what are the various opportunities in the various stocks in that particular conducive environment, because the environment is allowing growth, environment is allowing a lot more opportunities, and which companies are going to be able to take advantage of the opportunities but are not priced accordingly. So it's not just about growth, it is also about price. And the questioner rightly pointed out that the price has gone up, and we are also saying the same thing, that the indices have gone up quite a bit. So one has to be careful. And this is not a market where you can say, I will buy Nifty 50 and be done with it for the next few years, because some of the growth is already reflected in the price.
And there are few more questions on how people residing in Japan can invest in your fund. Same is for Europeans, and how that taxation will get applied to Europeans.
Yeah, so the way it works is for Japan and Europe in general, we have some investors from Singapore, from London, and so on. And I think the way it works, and I think first, I'm not a tax expert. So first, the people should understand that what I'm telling you is what I understand from investors who are invested in our fund. But this is not a tax advice. They should consult the tax advisor. But my understanding is that the fund pays taxes for any capital gains and dividends in India. And then we allocate out those taxes to all the investors through K1. And then the investors take that K1, and when they file their taxes in the corresponding jurisdiction, they say, listen, this is my income from this fund, which I'm invested in the US, and these are the taxes that I've already paid. India has most of the time agreement with most of the countries so that you get a tax offset for the taxes you have paid in India. But each individual country may have a different situation. And so you have to figure out if that works for your country. Of course, if there is any specific question, you have my contact details here. So feel free to reach out. I'm happy to go into some more details, but I will not be in a position to give a conclusive answer to you. That answer can only be given by your tax authority or tax professional in your jurisdiction.
Yeah, and question from RM. So RM, we have actually discussed this about allocation for US between US equities and Indian equities. There is a recording. We will publish this recording. You can actually go through it and then understand it. And in any case, Rajiv has offered this that you can reach out to him in for further discussions if you want to have. So. Yeah, so with this, Rajiv, we were having 60 plus participants today. And yeah, it's very encouraging to really see so many people having shown interest in equity investment. I think this is because of your credential and so on. I first of all thank you. Thanks all participant to uh, post your questions here and also be candid in the discussion. With this, Rajiv, shall we say? I mean, can we conclude, or if you have any last or few more points, feel free to discuss, and then we can.
Yeah, no, I think we are already over by a few
Yeah,
minutes.
15 minutes. Yes.
We'll give people back their time. I think thanks a lot, Sandeep, for organizing this. I always am happy to talk about investing because it's a passion project for me. And so I think I do feel that one of the best ways of getting good returns over time is equities, right? But this is over time, and one has to be mindful that in the short term, it could be risky if you don't understand what you're doing. So it's very important to become more familiar with what equity investing is all about. But it is one of the better ways of investing and improving your financial situation. And so I will encourage everybody who has participated to explore and see what is the best way that you can take advantage of the investment opportunities that exist in India. Thank you very much.
Yeah, thanks, Rajiv. Rajiv, one more thing people have asked for, like how do we share? I think you can post a YouTube link or something so that we can share with all the participants here. They can. I'm not sure how you want to actually go
Sure. So
about
I
it.
will put it on YouTube. And Sandeep, because I don't have the attendees list, maybe I will send it to you. And so you can
Yeah,
send who
yes.
has registered so that they will have the recording once we have it.
Sure, super. Thanks again, Rajiv. Thank you. And thanks all the participants. It was really encouraging to see you all here. We will surely organize similar events more so that you get benefited from likes of what has been shared by Rajiv today. Thank you so much.
Thank you, everyone. Bye.
Thanks. Bye.